Good evening, everyone, and thank you for attending our 2014 market briefing. So the title of our briefing tonight is Philippines to Toe the Line, Opportunity to Accumulate at Good Values. So I'd like to start out by explaining to you what towing the line means. So towing the line means, according to Wikipedia, an idiomatic expression to conform to a rule. So we chose this title simply because, just like to point out that in 2013, the PSEI went ahead of itself, okay? So as you can see from this chart, at May, before the correction took place, the market was trading at 21 times PE. So historically, the PSEI was trading at an average of around 15 times PE. So clearly, you can see that we were a bit stretched at the time. We were going above the rule. And the reason why this took place was clearly there was a lot of liquidity globally. So what are the evidences? If you look here, you can see that the foreign investor participation, or the share of foreign value turnover in the PSEI, was increasing quite a bit. And in 2013, in fact, during the first five months of the year, it was up by 109%. And because of ample liquidity also, our 10-year T-bond rate fell from around 7% in 2011 to only around 3%. In fact, I think it hit a low of around 2.8% during the first half of 2013. So these are signs of ample liquidity around that time. And well, unfortunately, the trigger of the sell-off in May was brought about by all these talks of tapering by the US Fed. And the reason why it triggered the sell-off was because it implied prospects of reduced liquidity. Recall that it was liquidity that pushed the market higher. Therefore, the possibility that this liquidity would diminish created a lot of fears and concerns in the market. So here is the timeline of the news for the tapering. So on March 22, the Fed minutes noted that a number of the participants of the Fed expressed willingness to reduce quantitative easing as early as June. Okay, on December 18, the Fed announced it would start to taper the bond buying program by 10 billion. And it started it in January, but January 29, they said that they reduced it by another 10 billion. So now the monthly bond buying program is down to 65 billion. Okay, so right now the sell-off is continuing, and there are a lot of factors negatively affecting the market. First, the normalization process is not yet over. We're also seeing weakness of other emerging markets, or EM economies. This is something that we've already discussed 6 months ago. Contagion risk, and it is continuing to hurt the Philippines. And finally, there are a lot of bad news locally. So we'll talk about them one by one. So the reason why we think that the normalization process is not yet over is, if you look here at the valuations of the Philippines versus other markets, you can see that we're actually one of the most expensive in terms of PE. And in terms of EPS growth, we're also the slowest. So if you attend our fundamental analysis seminar, you would know that we always talk about PE in relation to EPS growth. It's okay to have a high PE as long as your EPS growth is fast. When foreign fund managers try to evaluate which markets they will invest in, this is the first thing they look at. They look at your market's PE and they relate it to your EPS growth. If your EPS growth is slow and your PE is high, they will not invest in your market. Also, if you compare the PE of the PSEI right now, it is still above the 10-year average. So that's another measure that foreign fund managers look at. So if they look at the Philippines right now, they think, well, yeah, it has corrected, but it's still a bit pricey. So that's one of the reasons why foreign fund managers continue to stay out of the Philippines, and foreign selling is still continuing right now. Okay, as far as interest rates are concerned, we feel that there's still some room for interest rates to go up. So this is just a chart of the 10-year bond rate of the Philippines and the US. So the green line is actually the spread between Philippine 10-year bond rate and the US bond rate. So during the past 5 years, on the average, the Philippine 10-year bond rate is higher than the US 10-year bond rate by around 3.2%. And now it is only 1.4. Okay, it has actually increased already because it was much smaller at one point in time. So in a way, foreign fund managers are also viewing these numbers, and they're thinking, why should I invest in the Philippines when the bond rates in the Philippines are still very low? And the problem with low bond rates, well, this is another chart to compare the Philippine bond rate to other similar rated papers, other BBB rated countries, the interest rates. So we did a scatter plot of interest rates relative to inflation. And based on this line, the interest rates in the Philippines is a bit too low. Okay, so anything that is below the line means that the interest rates in those countries are too low. Anything above the line means that interest rates are a bit too high relative to inflation. So in the Philippines, our interest rates are a bit too low. Based on the best fit line, our interest rates for the 10 years should be closer to around 5%, around 5 to 5.2%. So anyway, so one of the reasons why foreign fund managers are concerned about the interest rate differential and our comparison with other BBB rated countries is because this would be one of the factors to determine whether or not the peso will strengthen or will weaken. Okay, if your interest rates are too low, usually that's one of the reasons for the currency to weaken. And we believe that the relatively low interest rate of the Philippines is responsible for the weakness of the peso. So for now, or for the year to date, and including the whole of 2013, the peso is actually weaker by around 10%. And if you are a foreign fund manager investing in the Philippine market, that would mean a 10% loss in the value of your portfolio simply because of the depreciation of the peso. And then, of course, we have the weakness of other emerging market economies. So right now, we have, well, aside from the PIGS, we also have the Fragile Five. You have Turkey, South Africa, Brazil, India, Indonesia, and of course, the TIPS, Thailand, Indonesia, Philippines. So if we compare all of them, you can see that they're out of favor. Their stock market indices are mostly down for the year-to-date period, well, except for Indonesia, but a 2.6% increase is hardly exciting. Same goes for the Philippines. We're virtually unchanged, but hardly exciting as well. Okay, most of the currencies of the Fragile Five are weak or weaker for the year-to-date period. And for the 10-year bond rates, most of them are going up also. Okay, because they're all suffering from capital flight or fund managers selling out their positions in those countries, going back to developed markets. So right now, in summary, emerging markets are no longer in vogue. What's in vogue right now is developed markets, your US, Europe, and Japan. Okay. It also doesn't help that we've had a lot of bad news lately. Okay, what pulled down the market includes lackluster third quarter 13 earnings of companies. Okay, Typhoon Yolanda, there have been a lot of negative publicity as far as the economy is concerned, as far as Yolanda is concerned. I think World Bank and Moody's Analytics have actually reduced our 2014 GDP growth because of Typhoon Yolanda. and even the fourth quarter GDP. There were some soft spots there. Construction spending was down by 0.5% during the fourth quarter. Government spending fell also by 5.2% despite being strong during the first 9 months. Okay, that said, despite all of that, we believe that the current market weakness is an opportunity to accumulate stocks. The reasons why we remain bullish over the long term include the following. Okay, most factors that are hurting investor confidence right now are noise. Then believe it or not, there is actually a lot of favorable economic developments. But the problem is, since people are so bearish right now, they're overlooking these positive developments. So I'll talk about them later. Okay, next, well, we accept that interest rates have nowhere to go but up. But these higher rates are already priced in based on our computations. And finally, if being Filipinos, we have to keep our assets in pesos. And unfortunately, fortunately or unfortunately, stocks remain the most attractive peso investment instrument that is currently available. Okay. So right now, we are suffering from contagion, or we are being associated with other emerging market economies. But if you look at this chart, we are actually stronger than other emerging market economies. So one of the major indicators that that economists and investors look at is the current account position of a country. The current account position is simply the difference of dollars coming in versus dollars coming out of the country. So obviously, if you have more dollars coming in, you'd have a current account surplus, and that's good for your country. If you have more dollars coming out than dollars coming in, you'd have a deficit. So as you can see, the Fragile Five, which is Turkey, South Africa, Brazil, India, and Indonesia, they all have deteriorating current account position, meaning there are less dollars coming in than dollars that they need. Okay, then they have more dollars going out. In contrast, you see the Philippines, despite 2013 being a bad year, we actually increased our current account surplus to 4.2% of GDP. So if you have a strong current account position, you are less vulnerable to the impact of a US Fed fund tapering, because you can actually do more things like defend your currency from speculation and other things like that. Okay. So impact of Typhoon Yolanda, well, as I've said, it will negatively affect GDP growth for 2014, but if you think about it, the impact is not going to be a lot. It's going to be only 0.3%, and this is according to NEDA. Despite all the devastation that we see on TV, Eastern Visayas, which was hardest hit by the Typhoon Yolanda, only accounts for 4.5% of GDP. And the government has already announced that there will be a 361 billion peso recovery in reconstruction spending from 2013 to 2017. And this will act as an offset for the weakness that we will see. So the budget for 2014 is actually around 90 billion. So going forward, I think it's going to be 80 billion a year in spending. Okay. Okay, construction. Earlier on, I discussed how the fourth quarter construction spending was flattish, when in fact during the first 9 months it was up by double-digit levels. But we really believe that the fourth quarter is only a soft spot. The government already announced the construction spending budget for 2014, and it's a 35% increase. Anyway, on the infrastructure spending, there will be an increase of 35%. So the target is they'd like to see infrastructure spending to eventually account for 5% of GDP come 2016. Because really, if you think about it, there is much requirement for infrastructure in the Philippines. My favorite example really is EDSA, and the amount of time it takes for people to travel just from Ortigas to Makati. I remember when I started working in the 1990s, when I used to live in Makati, it would take me 15 minutes to go home from the office. But now, when we go to meetings in the afternoon, 6 o'clock, takes us an hour and a half to get to Makati. So, there's no problem as far as over-investment is concerned, because we really need that investment in infrastructure. Country is really underinvested. Okay, and there's a lot of noise as far as PDAF is concerned, and how there will be no more pork barrel. How will it affect the economy that you're taking out 25 billion? But what are the facts? The removal of PDAF only reduced the budget by 3.2 billion, or this is less than 1% of the original proposed budget. So what happened to the 25 billion? So the bulk of the 25 billion was realigned to calamity funds and other projects. So we didn't really lose PDAF. It was reallocated. So the removal of PDAF will not really hurt government spending. And I just like you to focus on social services and economic services as far as the government spending is concerned, because these are what matter most. So social services will be increasing by 20.4%. So social services include the conditional cash transfer to poor families, construction and repair of classrooms, national health insurance programs. Economic services would include spending on roads, agriculture, and tourism. So these are spendings that matter, and they will be increasing by more than, the other growth. Okay. Then, of course, as far as the good news is concerned, OFW remittances and BPO revenues have remained quite robust despite all the concerns. So for the first 11 months, our OFW remittances still grew by 6.1% to around 20.6 billion as of November. And BPO revenues, the BPAP has already said they're quite confident of hitting 16 billion this year, and going forward, they're expecting a compounded annual growth of 18% up to $25 billion come 2016. So very positive numbers. Okay, so as far as exports are concerned, after a weak first half, exports in the Philippines have actually started going up as well starting June. And also included in the items that have gone up as far as exports is concerned is electronic exports. So electronic exports have also recovered starting June. So this is also positive for the government or for the economy. And the weak peso, although it's not good for fund managers, foreign fund managers, it's highly favorable for the families dependent on OFW remittances, for the BPO sector, and also for exporters. This would mean additional spending power for families dependent on OFW remittances. And for BPO locators, at least we become more competitive also for our exporters. And also, believe it or not, investments are actually picking up in the country. Foreign direct investments for the first 10 months of 2013 are already up by 35.3%. Our manufacturing sector is actually growing as well in terms of gross value adds by 8.3% for the full year of 2013. Okay, there are some factors which are driving investments. Okay, these would include our strong and resilient domestic consumption, credit rating upgrades, improving competitiveness of the Philippines, strong and liquid financial system. So we'll talk about this one by one. Okay, so our domestic domestic consumption in the country is very strong. So as you can see, during the past 10 years, it has consistently been positive, although it was only 2.3% in 2009. This was during the global financial crisis. It continued to grow despite that. And the drivers have been the resilience of our OFW remittances, our growing BPO sector, and the young and growing population. Going forward, we expect consumer spending to remain strong as we enter the demographic sweet spot from 2015 to 2050. So I know you are all quite familiar that we talk about this almost every briefing, that we are very positive because strong demographics is something that is difficult to change. Okay. And also recall last year, one of the major developments for the Philippines, if you talk about what were the major achievements in 2013, I would think that being able to get an investment grade rating from the 3 major ratings agencies is actually one of our greatest achievements for 2013. So last year we had Fitch, S&P, and Moody's upgrading the Philippines to investment grade. And recall that some countries actually cannot invest in countries which are below investment grade. So now that the Philippines is investment grade, it is already in the radar screen of a lot of investors. So in the past, we weren't even considered as a possible investment destination. Okay, so just some updates about labor costs in other Asian countries. So labor, in the past, they've always said that labor in the Philippines is very expensive. But right now, we're slowly becoming more competitive as the minimum wage in all these other countries have gone up. Okay, so in Thailand, well, they increased the wages by 35% last year. The unemployment rate in Thailand is actually less than 1%. Okay, in Indonesia, last year they increased the minimum wage by 40% in Jakarta. Unemployment rate in Indonesia is 5.9%. In the Philippines, our unemployment rate is 7.5%. And last year we increased our minimum wage by 2.3%. So that's a big difference there. China, I did not include here, but China, the average annual increase will be at least 13% in the next 5 years ending 2015. This is because, according to the 12 5-year plan, salaries have to double every 5.5 years as the government wants to shift or change the nature of economic growth away from investments into consumer spending. So it's no longer cheap to have products produced in China and all these countries. We're becoming more competitive. Okay, and again, some good news. The Philippines was most improved for doing business according to a World Bank and IFC report, Doing Business 2014. Okay, we improved by 30 places or 30 points to 108 out of 109. 189 countries that are being reviewed for the period. And according to the report, the reason why we improved by 30 places is because there are less requirements to obtain construction permits, improved access to credit information, and according to them, it's easier to pay SSS contributions because it's now electronic. Okay, again, the banks remain very strong and liquid. Okay, as of the first 11 months, or as of November of 2013, the NPL ratios remain very low, provisions remain very high. Banks are still, have only lent out 60% of the deposits, and in fact, if you include the SDAs, only 50% has been lent out. And we're already adopting Basel III because the capital adequacy of banks is already at 18.9% versus the 10% requirement under Basel III. Okay. So earlier on, I said that although interest rates or rising interest rates is a major risk, we believe that this is something that is already priced in. So we did a scenario analysis. What we did was we did a bottom-up approach, or the analysts in my team computed the fair values of all the stocks that they cover using 5% as the risk-free rate, and using 5.5% as the risk-free rate, because earlier on we discussed how we think that the interest rates would be around 5%, 5 to 5.5%. So based on the computations on the fair values that we've derived, we've come out with a PSEI target of 6,900 based on a 5% risk-free rate. So this is around 15% higher than 6,000. And the bear case, assuming that the 10-year bond rate rests at 5.5%, there's still some upside of 10%. So in that respect, we believe that the higher interest rates are already priced in. Compared to other options that are available out there, so what are the options? You have time deposits, SDAs, if you invest through money market fund. And if you're willing to hold on to a paper for 10 years, you have your T-bonds. So these are your options. And stocks, well, the yields of stocks based on an earnings yield or earnings over price, the returns on stocks are still more attractive relative to what's available out there right now. So these are just a comparison of the different products that are available, and where can you invest right now? And well, we believe that stocks remain the most attractive. So these are the pros and cons of the different types of investments. So for bank deposits, they're very liquid, but the yields right now are very low. So you have a high risk of losing purchasing power. For your money market funds, it's also very liquid, and the yields are higher than bank deposits. But the interest income is not paid out to investments, so the value of your money market fund will be going up only. And yields are still below inflation, although it's higher than time deposits. And as such, you will still risk losing purchasing power. For bonds, the yields are higher, especially for longer dated bonds. The problem is, right now, we know that interest rates are going up, and bond prices actually drop in response to higher interest rates. And the prices of longer dated bonds are the most sensitive to interest rates movement. So, for example, if interest rate goes up by 1 percentage point, a 10-year bond will drop more versus a 5-year bond. Maybe a 10-year will drop by 10% in price versus a 5-year bond will drop by 5% in response to a 100 basis point increase in interest rates. So in a way, if you buy a long-dated bond right now, you're stuck to it for the next 5 to 10 years. So hold to maturity na yon. For stocks, we realize that the major problem is volatility in the short term. But returns are higher compared to other asset classes over the long term. And the returns are less or not sensitive to rising interest rates over the long term. And the dividend yield of some stocks are actually higher than bond rates. So we'll show an example later on. And finally, one of the reasons why we continue to like stocks is because we believe that fundamentals will eventually catch up with price or valuation. So although 2014 might not seem like a good year for the stock market, 2015 actually looks like a good year. So assuming that the PSEI stays at 6,000 for the next 12 months, if you look at 2015, we're already trading at 14.4 times PE, meaning we're trading a discount relative to the historical average of 15 times PE. And EPS growth will now return to double-digit levels, or 14%. So in that respect, it pays to be a long-term investor because fundamentals will eventually catch up with the price. Okay, so before I move on to the next section of my presentation, I just like to summarize what we've talked about. So on the negative side, we have Philippine stocks in terms of valuations. Philippine stocks are not yet cheap compared to other markets globally. Interest rates still have room to increase. The peso could still weaken. On the positive side, there's nothing fundamentally wrong with the Philippines. Higher interest rates are already priced in, and stocks remain the most attractive peso asset class. So, I mean, if you look at this, the conclusion would be, although stocks will most likely stay here in the short term, they will continue to go up in the long term. So the question now becomes, should I buy now or should I buy later? So this is actually a question that was raised to me by some of our clients. No, they are saying that, well, if the market is not going to go up until the second half of the year at the earliest, why should we start investing now? Let's just wait for the second half to start investing. Okay, so let's just discuss, or let's try to analyze the differences of the strategies. So if we buy now, the positive is there is no possibility of missing out if ever the market does go up. But the negative side, there's opportunity cost of capital, obviously. You can't earn interest on money that's invested in stocks. And there's a possibility of short-term loss or volatility. Okay, and I think lastly, but most importantly, there's this emotional impact of short-term losses or prospecting. No? In behavioral finance, we call this prospecting. Okay, so have you ever wondered why it's easier to place money in a time deposit that yields less than 1% versus buying stocks of PLDT that yields a dividend yield of 7%? Okay, that's a huge 6% difference in returns. But people still choose investing in time deposits because, of course, if you buy stocks, there's this volatility involved and potential losses because of volatility, at least in the short term. So prospecting says that as human beings, we are risk averse, we're afraid of losses. If, for example, we lose 1,000 pesos, we are hurt more than if we gain 1,000 pesos. So the problem is, if you buy now and then your stock price goes down, you would feel that emotional pain, and it might discourage you from buying stocks. I mean, I know of a lot of people who will tell us, we've completely written off investing in the stock market because at one point in my life, we bought stocks and we lost money, therefore, don't even talk to us about buying stocks. Okay, so the next one is, okay, buy later, seems easy. Okay, we'll just buy later when the market is going up. Positives, there's no opportunity, opportunity cost of capital, so there's no opportunity loss. Okay, but on the negative side, well, we're saying most likely it's gonna happen in second half, but nobody really knows when the bottom will take place. By the time that it's confirmed that the market has bottomed, and well, I'm not a technician, but based on what I've learned from Juanes, you can only say that the market has bottomed when you see a higher high and a higher low. And if you look at the chart there, in 2009, the higher high and higher low manifested at 2008, which is 40% higher than the low. Okay? So prices can be significantly higher by the time we confirm that the market has bottomed. And the anchoring bias, which is another behavioral finance problem with investors, might cause you to miss out. Anchoring bias means we tend to think of stock prices or their old price. For example, dito, you see that in 2009 at 2.8, the market was higher by, it's a confirmation that the market has bottomed. Unfortunately, yung mga technicians na nakita ang 2.8, sasabihin, but it was only 2,000 6 months ago. So why am I going to buy the market at 2.8? I will wait for it to be 2,000 again. No? Or may mga ganong biases tayo because it's only human nature. We have this tendency. If we see a stock trading at a low price and it goes up, there is also this possibility that we might not invest. Okay, so the reason why we recommend peso cost averaging is we think that it is, in a way, a good compromise between the buy now and the buy later. So peso cost averaging involves buying a fixed value of stocks in a period of time and buying only when thresholds are hit. Okay, so you'd like to see at least a 15% upside. Some investors who are more conservative would like at least 20-25%. So you only buy when those thresholds are hit. What are the positives? It limits your amount of exposure, so your opportunity cost of capital, opportunity cost for your capital is minimized, and improves your average buying price, assuming that prices continue to drop, because we also can't tell where the bottom is. We can only look at some indicators to say that it looks like it's close to the bottom. And it creates discipline, removes emotions out of investing. So it removes prospecting and anchoring, takes them out of the picture. No? So we think that peso cost averaging is appropriate right now because risks are no longer as significant. As we've discussed earlier, higher rates are already priced in. So although we can't say where the bottom is, we believe we're close to it. And stocks remain the most attractive peso asset class at this point. So the opportunity cost for you to invest in stocks using the peso cost averaging is not significant because the alternatives that are available anyway are not too attractive. Okay, so going now to our stock picks. So if you read our monthly Calling the Shots, we already came out with this list in January. Okay, so the major changes would be the addition of the banks, BDO, Metro Bank, Ayala Land, and SM Prime, two property companies, and the removal of Pure Gold and RLC. So I'll just be focusing on the additions and removals. Okay. In a way, the addition of banks and properties are a bit contrarian at this point because banks are sensitive to rising interest rates. Same goes for properties. But let me just explain why we're adding back BDO and Metro Bank. We believe that valuations have already become attractive for the two banks. So BDO is now trading at only 1.6 times price to book value, whereas Metro Bank is down to 1.4 times price to book value. So these are very attractive levels for the two banks. We just like to emphasize that rising interest rates will only hurt these banks' trading income. But demand for loans remain robust. So if you read the newspaper today, I think BPI already announced that they're expecting a 20% growth in loans. Demand for loans has not weakened despite rising interest rates. And among the banks, we prefer the bigger banks because they're less dependent on trading income to generate profits because the bigger banks are stronger on the lending business because of their size. Okay, Ayala Land, okay, property stock. We kind of realized that sentiment for property stocks were also hurt in the second half of 2013 because I think foreign investors are concerned that with higher interest rates, property demand would weaken and prices of properties would go down. But we don't expect that to happen because the increase in interest rates in the Philippines is not expected to be that substantial anyway because liquidity conditions still remain quite robust, and we don't see any manifestations of a bubble yet, necessitating the central bank to be very aggressive in raising interest rates. Okay, so we believe that a steep decline in prices of property companies is an opportunity to buy. So Ayala Land is now trading at a 38% discount to its net asset value. And in the past, it had traded at around 26% discount. So this is wider than the historical average. And Ayala Land is expected to deliver among the fastest earnings growth among property companies, despite its larger size, and it has other strengths such as its huge land bank and numerous rental properties. Okay, SM Prime. SM Prime is a hybrid consumer and property play. Okay, despite the increase in its size post-merger with other SM property companies, we have to remember that around 60% of revenues and 70% of earnings before interest and tax in the next few years will still come from rental revenues, giving it a lot of defensive qualities still, despite being a different type of company now. And the large size actually provides it with numerous advantages over the long term. For example, it can now roll out it's in a better position to roll out large-scale master-planned mixed-use developments, such as the Mall of Asia complex. And it can now tap more financing options. And valuations are also attractive. Okay, SM Prime is now trading at 20 times PE versus the consumer sector average of 27 times PE. And it's also trading at a 30% discount to NAV, making it actually quite an attractive investment. Okay, why are we removing Pure Gold and RLC? As far as Pure Gold is concerned, it really is a valuation call. We believe that the stock is a bit expensive, and also earnings growth this year will slow down to 13% from 36% in 2013. So I think it's time to take profits there. RLC, we still like the stock actually. It's more of selling RLC to make way for Ayala Land, because between the two of them, we believe that Ayala Land is just a faster growing company, because by the nature of RLC, it's more of a defensive company focused on rentals. Okay, so growth is not going to be as fast as Ayala Land. So if you have RLC, you don't want to sell it, good and fine, you can still keep it. There's nothing wrong with that strategy. Okay, so before I end, just some more exhibits to inspire you to stay invested in the stock market. So we've gotten some examples in the past of rising interest rate environments for the US. Okay, so from 93 to 95, you can see there that the S&P 500 actually consolidated for 1 year when the Fed started increasing interest rates. But of course, after waiting for a year, the S&P 500 increased by another 217%. Okay, so it pays to be patient. So this is the first example. Okay, so 1 year of wait is not a long time for a 200% gain. Okay, second example is S&P 500 from 03 to 05. Okay, in 2004, the Fed hinted that it will soon raise interest rates. So the S&P 500 consolidated for 5.5 months. But after that, after consolidating, the market proceeded to go up by another 35%. Okay, so in that respect, I'd like to end my presentation, and I hope that I have inspired you to stay invested and keep on investing in the stock market. Okay, thank you very much.